Hello, welcome to the weekly market view from Capital Spreads. I'm joined once again by Bill, who's back from 2 weeks holiday in Egypt. Bill, looking very, very healthy indeed.
Very much so, thank you. It was great.
Good to have you back.
No laptop, no mobile, and no BBC.
No BBC, gosh, poor you. Okay. But speaking of the BBC, obviously coverage of George Osborne's autumn statement yesterday. And it's nice to see, I suppose, the Chancellor actually producing something, delivering something that hasn't ended in controversy in some sort of capacity tax or something like that. He actually sort of came out of it pretty well. Mm-hmm. But what does it mean? What does it mean for UK, the UK and sterling in particular, and ultimately, because he's extended that target by a year or 2 years or whatever it is, what does that mean for our AAA credit rating?
I don't think it makes any difference. I mean, I think that's, of the 1,000 things we could talk about, that probably is 1,001. I don't think it makes any difference. And let's just go back to August, 3 years ago, when the U.S. lost their AAA credit rating, right? We saw bond yields fall to the lowest level in history. And I think, you know, that's meaningless. What I do feel that it means is that we will probably see the Bank of England MPC probably implement quantitative easing sometime in the first quarter of next year, because one of the things that wasn't brought out but we all knew is that the Treasury had sort of raided the Bank of England for about $38 billion in coupon, so that sort of soothes something. So if the Bank of England again comes in and starts quantitative easing once more, that is another sort of sublime implementation of more money into the Treasury.
And do you think that's going to actually help growth? Because of course ABR, the independent Office of Budget Responsibility, they reduced their forecast for growth next year, and yet they still seem to be relatively optimistic compared to other forecasters.
Well, I guess to be tacky, whatever they're drinking, I'd like a double.
Yeah.
I think one of the things that was brought up, and maybe yesterday that maybe people didn't look at, was of the G7 over the last 4.5 years, okay, the only worst country in reference to growth versus our -3% negative growth has been Italy. And I think one of the things which I thought was rather silly, when he sort of made comments or inferred comments about us versus France. I think what we have to do is, if we're looking to compare our growth, whether it be the UK, the US, the Eurozone, we have to look at it in reference to the people that are doing extremely well, and that's Asia in some of the BRICS, and we're falling farther and farther behind the real movers and shakers of the next 10 to 15 years, and that's concerns.
Yeah, so you think that those growth forecasts, even the more realistic, well, the lower ones by other forecasters in the city, even they're too optimistic?
Yes, I do. I think the simple fact is we could even have a triple dip. And I think that's one of the things where, with the Bank of England, I know they did nothing today, I still feel that there's probably, in the first quarter of next year, we'll probably get QE, whatever you want to call it, another 50 billion.
And on the theme of central banks, obviously ECB as well today. So you've been calling for a rate cut that hasn't come yet. Now, it would seem also, when compared to a month ago, where people were expecting, certainly if it wasn't this month or the month before, there'd be a cut at some point in 2013. And even now, people are reining that in and expecting things along.
Yes and no. And I think one of the things, it's difficult because if you use the option-adjusted spreads against where they're like 2 years of trading at swap levels, it's very difficult because you have almost artificial buying in here because, quote, you have safe haven buying. I mean, you know, you saw Italian bonds now trading at a 15-month low. You've got Spanish bonds at 5.25. You're actually having people buying the bond market as the safe haven. And, you know, my feeling is, and I think there were 5 or 6 people who, in a Bloomberg survey, were expecting the possibility of a rate cut day by the European Central Bank. I do know, and I won't mention them now, one institution that is talking 2 rate cuts by the European Central Bank in the first quarter of next year. The market is implying a 72% probability of 1 rate cut in the first quarter of next year, and I do have to feel that the European Central Bank will do it. I think one of the things maybe people have forgotten, Mr. Trichet, one of his last comments in the early part of this year, excuse me, 132 to 135 euro dollar was that proverbial line in the sand. Now we seem to be failing at 131, but if the euro starts to rally, this is going to be a very negative, especially for France and Germany in reference to exports.
Yeah, interesting. Okay, and so let's shift our focus across the other side of the Atlantic. Good old US of A. Loggerheads there again. Fiscal cliff has actually caused European markets haven't been affected so much by it, but the US market's definitely softer on the back of that. Do you think we're going to get a deal?
As a human being, as an internationalist, yes. I think one of the things that people have to understand is 78% of the House of Representatives, remember they come up for re-election every 2 years, 78% of those are re-elected every 2 years. The only ones that aren't are the ones that either retire, either die, or have a slight social problem, if you get my drift. So I hope, and of course, we've only got 2 weeks from tomorrow, and then they go on Christmas break. I mean, the European equity markets are trading on the simple fact is, hopefully, they will act as adults rather than stupid politicians. And I think I just can't see the fiscal cliff happening on the 31st of December. But I also know that the Federal Reserve, the Treasury, can sort of fudge the numbers, at least into the first quarter of next year.
Okay, so it's still very much jury out on that one. And then just to finish off, non-farms tomorrow, what's your call?
Mine's plus 75.
Oh, right, quite late.
And I think, again, I'm looking under the assumption that Hurricane Sandy dropped 125,000. So basically, less that, and it will have far more of an impact than Katrina did. But yes, I think the consensus number is plus 93.
Yeah, okay, yeah, it is. And so basically, without Sandy, you're looking at 200.
Yeah, again, not a great number, but at least a slight improvement. Okay.
Brilliant. Bill, thanks very much.
Thank you.
Great to see you.
It's great to be back.
Okay, thanks a lot, Bill. Thank you.